On 28th of February, while many of us are still celebrating Chinese New Year, the world changed again. United States and Israel launched an attack on Iran. Oil prices spiked, global markets reacted, and headlines exploded everywhere. And almost immediately, a lot of people started asking, should we hold off buying property? Will prices drop? Is this the start of a global crisis? Today, I want to answer one very important question. Why does the war in Middle East actually mean for Singapore property market? And more importantly, how should investors think about property in 2026? First, let's acknowledge something. War creates uncertainty, markets react emotionally, the oil prices may rise one day, inflation fears may appear, stock markets may become volatile, but that's completely normal. Here's something most people forget. Headlines create emotion, fundamentals create value. And you're investing in real estate, especially in Singapore, you must learn to separate the two. If we look at Singapore property history over the last 30 years, there are really only 3 events that caused major price declines. Number 1, the Asian financial crisis of 1998. This was a real systemic crisis. Currencies collapsed across Asia, banks were under stress, companies went bankrupt, unemployment surged, and Singapore property prices fell around 40%. Why? Because the financial system itself was breaking. Second, global financial crisis of 2008. When the Lehman Brothers collapsed, the entire global credit system froze. Banks stopped lending, liquidity disappeared, global recession followed. Singapore property prices dropped by about 20 to 25%. But interestingly, recovery came quickly once the liquidity returned. Number 3, government cooling measures, 2013. This one wasn't a crisis. It was government intervention, ABSD, TDSR, loan restrictions. Prices corrected about 10 to 15% very gradually. No panic, no financial collapse, just policy cooling. So now you ask yourself this simple question. Today, in 2026, do we have a banking crisis, credit market freezing, massive unemployment, property oversupply, or major new cooling measures? The answer is no. What we are seeing today is uncertainty, but not structural collapse. Now, let's take a look at the real fundamentals. In Singapore, the banking system remains strong. Household incomes have been rising steadily. Median household incomes have crossed 12,000 per month. Average household net worth is now around 2 million. That means something very important. Singapore homeowners have strong holding power. There's no forced selling environment. And another major factor, interest rates have fallen significantly over the past 18 months. If you study the property cycles carefully, something interesting happens after sharp interest rate cuts. In 2008, when the rates dropped sharply, property prices rebounded strongly. 2020, the rates dropped, and same thing we see. Property prices surged over the next few years. Why? Because lower borrowing costs improve affordability. Then prices follow, which creates a very short window in the market, an inflection point where the affordability improves before the prices accelerate. And in my view, 2026 is shaping up very much like that window. When global uncertainty increases, capital looks for safety, and Singapore has always been viewed as a safe haven. Strong political stability, strong currency, transparent regulation, limited land supply. So when global risks rise, investors don't just run, they reposition. And smart capital will flow towards safe assets. And in Singapore, real estate is that safe asset. Here's my professional view. Should geopolitical headlines influence your property decisions? Emotionally, they might, but fundamentally, they should not. If you are looking to buy a property for next 10 to 15 years, short-term noise should not derail your long-term fundamentals and value. In fact, periods of uncertainty like this creates good entry opportunities. When confidence is high, asking price can also be high. But when sentiments become cautious, there will be negotiation, there will be less people buying, and that is your time to strike. So let me leave you with this thought. Crisis does not test the market. Crisis tests your conviction. There's not a perfect moment to invest, but there are windows where positioning becomes important. And in my view, 2026 is not the year to panic. It is the year to position. So focus on the fundamentals, ignore the noise, and make decisions with clarity, not through the headlines. I'm James. Thank you for watching.